Welcome to the Dairy News and Views podcast, a production of the Iowa State University Extension and Outreach Dairy Team. Our podcast covers current educational, research, and industry tools available for your operation to manage healthy cows and calves while producing the highest quality dairy products.
So we're going to start on just with the big difference of cash flow and profitability. And what I tend to find is that there's just such a big misunderstanding from producers, from bankers, and just what the difference of these two things are. And so we're going to actually try to provide some detail on why one's important here and another one's it might be important there. So we realize that every farmer around manages their finances just a tad bit different. They actually think about their finances different as well. And one of the things about making dairies profitable, we always tend to have this thought process of minimalist thinking farmers versus optimalist thinking farmers. And that actually shows through in the profit records as well of how they think about it. Operating profit margin versus asset turnover ratio, and just how they try to work with their profitability on their given farm. We also realize that a lot of a sense is that economics of dairy farming is not just about the profitability of the farm, but it's the quality of life as well. And there's a lot of things that come into play as farmers make what they think are profitability decisions, but the quality of life is a big piece of that picture as well. So the big three financial statements, I'm not going to spend too much time in here, but again, in order to do a profitability analysis, we undoubtedly need a beginning and an ending net worth statement. So I like to think of that as just a picture or a snapshot that you're going to take on January 1st each and every year. Last year's ending is this year's beginning. And so we have that picture, and then that picture, you're going to see the number of cows, the number of acres, the tons of feed and things like that. And everything's got a dollar value attached to it as well. And so without that net worth statement done on January 1st, if that's your tax year from the 1st to the December 31st, it has to coincide with your tax year because a lot of things can happen even in 2 weeks. If we have a tax year that starts on February 1st, but our net worth statement starts on January 1st. So those two really have to coincide. The second statement is a net farm income statement. This is kind of like a video camera that goes through the farm business from beginning to end. And in that video camera, you can see where incomes come in, expenses go out, a cow might die here. Okay, but all the events that happen that have a financial consequence on that farm or in that net farm income statement. And then the third one, which is kind of a wildcat in some respects, is a cash flow statement, because this thing mixes a lot of non-farm type stuff. It mixes investments versus expenses. And so it's got all sources and uses of cash, both farm and non-farm. Okay, so when we take a look at that whole thing about cash flow, it's just there's a big misunderstanding about its uses, and sometimes it gets way overused in making decisions, I tend to say, on farms. So when we manage dairy farm finances, we tend to say profitability. I put that as number one, because farms that tend to be more profitable tend to be more solvent over time. They tend to be better cash flowing farms over time, and they just tend to be, just financially healthier places for the farms themselves. So our goal is to cover costs and accumulate wealth. And I say less than 45, that tends to be a big goal for people that are under age 45. Solvency, as we avoid losses and wealth reduction over time. So once you get to a certain age, security tends to become more important. You don't really care to take as many risks. And then liquidity, again, there's that word cash flow. Now we need to be able to pay our bills on time, and it gets to be pretty important to pieces of it. And then we also work with a lot of farms that have psychological income, even sometimes as their primary goal, even above farm profits. Okay, so there's the quality of life. They do it because of what they love to do. And sometimes they'll forego profitability because there's psychological income, the quality of life aspect of it. So bottom line, when we take a look at profitability, this is our equation. That profit is equal to price minus cost. We can either increase our price or decrease our cost, and thereby we're going to increase our operating profit margin. Or we can simply, with that same operating profit margin, you think of our larger dairy herds with more milk, more cows, they simply produce more. Okay, so they twist it on that piece of the equation. With that profit, you can think of return on assets. The price minus cost is our operating profit margin, and that volume is our asset turnover ratio. So how long does it take to gross enough income to pay for all the assets on the farm? That's our asset turnover ratio. The operating profit margin is basically every time you get paid $1 in milk sales or whatever, how many cents on the dollar do you save percentage-wise towards your own family living after all expenses are gone. When I do profitability, like I said, return on assets, because that's something that marries the net worth statement and the net farm income statement, very all inclusive. Okay, so if we're only going to go with one measure, that's the go-to. The milk production cost per hundredweight, I'm going to show some data actually from Wisconsin and some of the things that they've done, and just why the milk production costs are so important to profitability as well. And then the third one is return to unpaid labor. And as we go more and more towards labor efficiency in our operations, I tend to say that might be a go-to more so in the future, the more and more labor problems we tend to have on the farm. So those are the three go-tos that I would tend to say. And in any given farm, when I'm doing a data set and trying to say what farm is more profitable, sometimes the one with the lowest milk production per cost per cow might have a higher return on assets or less return of unpaid labor compared to another farm. And so sometimes it takes all three of these measures to say, yeah, this farm I think is more profitable than that farm. When we take a look at making decisions, I think it's pretty important for us to realize that making decisions on cash flow tends to be quite faulty for a lot of farms. So bankers really focus on cash flow and equity. So if something goes awry, they need the cash flow that's got to come from somewhere to pay those debts back, or they need to be able to take some equity to do it. So they're trained very well to do that. But again, it might not be always in the best interest of the profitability of the farm long term. So we also take a look at cash flow, the debt expense. Okay, I tend to say that's a misquote because your principal payment is actually in the cash flow. Okay, the interest expense is also in the net farm income, so it's in the cash flow as well. But that principal part needs to be thought of as an investment, not as an expense. Okay, the cash flow also includes some non-business factors, and it's not always a strong correlation to profitability. So again, we need to be cautious about using strong or cash flow as the main measure to determine if we're going to invest in something or not. So this is what a cash flow statement looks like. So you got your beginning cash balance, non-farm income, again, not related to the farm. Income taxes paid may or may not be farm related. The principal payments, you may have some from a personal, you might have some from the farm as well. Family living expenses, again, a non-farm expense. Your capital purchases, and this could be both farm because it could be a non-farm one as well. You might be investing in an IRA or something like that. Capital sales, new money's coming in, and then the big one is the net farm cash income. So that one is heavily related to the farm, but the basic bottom line is that there's a lot of factors here with cash flow that really aren't even related to the farm, but the bills need to get paid back, and the bank really doesn't care where it comes from, if it comes from a spouse or it comes from the farm. So the other piece about cash flow is that a lot of times people take a look at their Schedule F and say, well, I didn't make much money this year. So Schedule F, doesn't always relate to profitability or cash flow one way or another, partly because of depreciation expense, especially if it's section 179, when you take a look where you can depreciate a lot of things in a short order, sometimes 100% in that first year. So there's a few things on that Schedule F that really aren't very correlating to cash flow or profitability either. Okay, when we take a look at why have a cash flow budget and spend time, I think there's three primary reasons to work with it. When we take a look at the cash flow itself, so during poor profitability times, we realize that cash flow needs to be the focus, okay, because it needs to get us on the other side of the crisis. And so any business goes through its peaks and troughs, its peaks and valleys, okay? When you take a look at cash flow, the important part is during those negative times where things just aren't working out, is that we need some excess cash flow. It might come from someplace else, a new loan, maybe from some savings or someplace, or our accounts payable might just build up, but that cash flow is pretty important to get us through the tough times. So the cash flow, again, does not equal the income statement because like it's scheduled with the depreciation, the inventory changes, accounts payable, accounts receivable, and things like that. But it does include those principal payments that we talked about, that again, it's an investment, not an expense, and all the cash payments we might use for capital assets and things like that. So things that should be depreciated out over years, but we're paying 100% of the cash for it right now. So there's a lot of things that are included and are not included with it. Just the bottom line here, you can cash flow very nicely while going broke. So think of capital assets sales or accounts payable, that we can sell cows and just sell a lot of cows and we can keep our cash flow positive, but at some point we're going to run out of cows. Okay, so we can kind of go broke as we can still manage to be able to cash flow. It does not equal an enterprise budget. Again, depreciation, opportunity costs of operator labor, opportunity cost of operator equity tend not to be on there. So when we take a look at budgeting, yeah, it's important for us to cash flow budget so we can figure out when those bad times are going to be so we can try to work with it. But the cash flow budgeting definitely I think is an important piece of the puzzle. Everything that goes into a cash flow. So it comes in from the farm operations, from capital assets sales, and again, they could be personal, they could be non-farm as well. Other non-farm sources like a spouse's non-farm income, loan proceeds, or something that might come from either Uncle Sam or another uncle you might have that gives you a little donation to the farm. So a lot of things that go into this. And then on the other side, we have these expenses. And so we have our operation expenses that come back out, capital asset purchases that are going to come out, especially we're going to pay cash for them and not incur the debt. Other non-farm expenses that might come in the way of IRA investments or just buying a personal vehicle or whatever, and then the debt service. So both the interest and the principal are part of that. And the cash flow will include those principal payments again, which are an investment. So if I'm showing negative cash flow, what do I do? Okay, so cash flow can't be negative. Those bills got to be paid. And so unless we're going to be going into bankruptcy or whatever, the cash flow can't be negative because we need to keep the business going. So if my cash flow budget is a positive $175,000, which means if all goes according to plan, I'll have a profitable year. So is that true or false? Maybe. So we don't know for sure, because even with a positive 175,000 in cash flow, that can go down pretty easy on a pretty good sized dairy herd. So we realize that depreciation is a real cost that reflects the loss in value of a capital asset due to wear, tear, and obsolescence. However, it is a non-cash cost, so it should not be on the cash flow budget. Is that true or false? And that would be true. Take a look at purchase feed as being the highest one, and then followed by some of the hired labor. And so those are important pieces, and people really focus on the feed part of it, and they focus on the feed part of it, and they focus on the feed part of it, and thinking that's their way to reduce their cost of production. Okay, but I think there's some other things that come into play with it as well. So when we take a look at raised feed is not a part of this picture, at least it's not identified separately, but it is in the land rent, it is in the seed, it's in the fertilizer, it's in some of the machinery expenses and things like that. It's in some of the labor, it's in the depreciation. So all that raised feed might be going through a lot of those different expenses as well. And the same thing with unpaid labor is a big cost often on a lot of farms, especially for those that don't hire a lot of labor, but that's not actually in these operating costs either. So when we take a look at total labor per hundredweight equivalent, we will actually see a very good correlation of total labor costs and cost of production. So labor efficiency, we realize in the last 5 to 10 years in the dairy industry is extremely important. And I try to put it ahead of feed expense, even just because I kind of feel, and from the data that I see, it's definitely a very important one. Okay, if we take a look at feed purchased per hundredweight equivalent and look at their cost of production, you'll notice that it's a lot smaller correlation compared to what the labor efficiency of the total labor cost is. Okay, so again, labor efficiency and feed costs both important, but if I'm going to put one ahead of the other, I'll probably put labor efficiency ahead of it at this point in the ballgame. When we take a look at different benchmark efficiencies, there's a lot of things we can take a look at on dairy herds. And so when we take a look at conventional herds here and hybrid grazing herds, which are grazing herds that take the best of the confinement world, and they also take the best of the grazing world and the Amerius system together. And then we have our organic herds and our organic herds that are no grain. When you take a look at labor efficiencies, 1.2 million pounds of milk sold, 1.2 million pounds of milk sold for the grazers. And these organic ones are actually much less labor efficient, but a lot of times they're growing a lot more feed. They might have 3, 4, or 5 acres per cow compared to these operations over here that might only have 1.5 acres per cow and buying a lot of the feeds as well. And you can see a big difference in milk production amongst the systems as well. And so when we talk about profitability, we need to be very cautious when we start comparing systems on profitability. And it's all got to come down again to that rate of return on assets and that cost of milk production, and also the return to labor per hour, to really compare those in an apples to apples approach. When you take a look at paid versus unpaid labor, renting land versus owning land, the interest charge versus an equity charge, so what we pay the bank versus what we pay us, those are all big factors in trying to determine profitability from the different farming systems, or from big farms to small farms. So just kind of want to throw that out just as a caution. When we take a look at the average of big farms and little farms, sometimes we'll take a look at the larger farms, we're getting $37.58 per hour. The smaller farms only $31.85. And people would say right away, well, that means that the bigger farms are more labor efficient than the smaller farms. But if you take all that and divide it down per FTE labor, not just with what the owner's making, but break it down on all of it, we'll actually see that our smaller farms tend to be just as labor efficient. And in this case, in this data set, we're actually more efficient than the bigger farms even though the labor earnings per hour were better for the owner operator. So when you take a look at the average, was 2331 for the average herd, 2265 for the larger herds, and 2485 for the smaller herds. For the return to all the labor, the smaller herds were actually better. So again, we got to be careful when we start talking about labor efficiency and just this labor earnings per hour for the owner operator, is it for the whole farm, to see which one's more efficient when we cross compare farms. So here are the 3-year average on these farms: the conventional herds at 624, the grazing herds at 672, and the organic herds at 859. So everybody says, well, these organic herds must be the most profitable ones because they have higher net farm income. And I tend to say that's probably not so, because we realize in the net farm income, the bigger herds probably paid more debt expense, and they probably have a lot more hired labor than the grazers or the organic herds, just suspecting. Okay, so when we take a look at 624, we could probably negate another $400, even $800 of monies that are already accounted for in this system that may not be accounted for in an organic herd that doesn't hire any labor and also doesn't have any debt. Okay, so even though it shows here that this one's more profitable, doesn't take too much to say that these are going to be a lot more profitable by the time we go through and do a full cost analysis. And so that's just one reason why I think when we do this thing, we can't use net farm income. You got to go through a full cost analysis to see what's really happening on these farms. How come some farms make more money than others? Again, this is Wisconsin Dairy Farms from 2014 to 18. When you take a look at the net farm income from operations, you will see a big difference in the net farm income from operations. You also see a big difference in the cost of production. So milk per cow only has a difference of 3.8% between the lowest third and the highest third. The debt per cow, we always talk about these high debt herds have high expense. We're going to have an equity charge whether they're paying the bank or they should be paying themselves. So the debt's more of a cash flow type thing problem. And the cost of production per hundredweight, there's a 15% difference. So again, cost of production tends, to me, in my mind, to be the biggest driver of the difference in profitability on farms. When we take a look at the average cost per production, the highest 75th percentile cost of production at 1885, the average at 1686, the lowest 25% at 1508. So close to $3.80 some cents or 77 cents with that. So just a very high range in cost of production. And most of the studies that I do, whether it be organic, confinement, or grazing, I tend to find some very high variability in cost of production. So how are profits created? So you can work your assets and you can turn your assets into gross revenue. You can also be efficient by turning that gross revenue, once you get it, into net income by really saving on your expenses. And the third way you can do is, once you have a profitability equation pretty well picked up, you can borrow some more money and use somebody else's money to grow your herd and do the same thing, but actually have higher volumes with it as well. So the first one is working your asset turnover ratio. And so basically it's how many years does it take to gross enough income to pay for all the assets on the farm? That's your ATO. So is it 3 years? Is it 5 years? 3 years is healthy. Sometimes I get into herds that are doing it in 2 years. I've got one right now that's even less than 2 years. Okay, so they might be having more rented assets versus owned assets and things like that. But it's definitely possible to have some pretty high ATOs. In addition, the operating profit margin, again, that's that price minus cost squeeze. We're going to be efficient here. We can either increase our price or decrease our cost, and that's going to be that piece of the puzzle. And we can try to do that as how much money we can save on the dollar for every dollar of income with us. And then this last one, again, is just kind of our debt to asset ratios, basically letting somebody else's money work for you in the operation. Okay, so the bottom line is this plays into this equation quite well with all things considered. So the top versus the low third return on assets on farms, you can get a pretty good size difference, 7.6%. You can see the differences. And so it's not always the big farms that tend to have the highest profitability. Even everybody said, though, we hear a lot, get bigger, get out, economies of scale. I don't subscribe to that thought process very well at all. Maybe I should subscribe to it better than I do, but there's a lot of small farms that still are making a pretty darn good living milking cows. Okay, so the additional production by the top versus the low herds. And this is where I tend to say is that we focus so much on feed and we focus so much on production. And I tend to say we should be focusing more on cost of production and labor efficiency, but they're all pretty darn important for us to take a look at. When we take a look at the difference between these herds, again, there is definitely some significant difference on the herds, at least the 1640 and the 1711. When we take a look at additional revenue due to production differences with those larger herds, it definitely, when you start taking a look, even a little bit of a difference, and you multiply it by a lot of pounds and a lot of cows, that definitely plays into part in it. So the cost of production of top versus low third return on asset farms, when we take a look at those costs of production, it is dramatic. Okay, so when you start taking a look at $3, $4, $5, $6 a hundredweight, even approaching $7 a hundredweight difference on the top versus the low, cost of production, I would tend to say, is the equation I truly want to work with on the farms. So when we take a look at additional revenue due to cost of production differences only, that it's about $1,000 a cow when you start taking a look at some of these lower herds, if that's kind of the herd size. It's probably over $1,000 a cow. So I think that's pretty important about what's happening with this, that the cost of production differences is a major factor on the profitability of the farms. So with all that said, now I think the next step is that we realize that cost of production, labor efficiency, and a lot of these things are actually in just the benchmarking are pretty darn important. So how are we going to do it? So we've got more than a few universities around the country that are using this dairy trans program to analyze the profits. What do you get? Is that simply we need a net worth statement at the beginning and the end. So last year's ending is this year's beginning. You use your Schedule F pretty much to get most of the cash flow type stuff and the net farm expenses. There's a few other cash flow items we'll need, and then basically just dividing it with the number of cows, the number of acres, and labor hours. And with that little input, we can get a pretty detailed scenario for an output. That'll actually do the net farm income. They'll do the cash flow statement, all your cost of production. There's about 80 different ratios in there for efficiency of resource use that really help us to analyze a farm business. In the interest of time, I'm just going to go right here. So basically, we have the income of $1,850 on this herd. We have expenses of $1,759, and in this expense, all the labor, all the equity, it's a total cost expense. It's a full cost analysis, and they still have 91 cents left over at the end of the year to take a look at it. Some people don't like that equity charge taken out, so we can do it without the equity charge. Some people don't like the labor, unpaid labor, or the equity taken out, so we can take that piece out of it, or we just take the labor out. So there's 4 different ways we can actually work with it. We'll also take a look at how efficient are they using labor in the operation? How efficient are they, on a per cow basis? How efficient are they on a per crop acre basis? And so when we take a look at doing that, you can basically take, this is again the producer's number, this is a goal, this is an average, and this is where they are between the goal and the average, for us to actually take a herd and try to analyze its profitability and actually kind of give it a ranking and see if they're more profitable than another farm as we take a look at it. So the 16 plus financial ratios. So we always said the sweet 16, but now there's some more ratios that we try to incorporate with this as well. But bottom line is I'm not a big cash flow guy. But basically we let that up to the banker to figure that out. But so once I tend to say if it's a profitable operation, let's work with it. And then once it's profitable, then let's figure out how to get it to cash flow. But basically, I'm taking a look at the return on assets, and I'm taking a look at the operating profit margin, this asset turnover ratio. So here in this one, you see it takes 1.8 years to actually gross enough income to pay for all the assets on the farm. When you take a look at the operating profit margin, again, for every dollar they received, they got close to 10.5 cents of pure profit. I'd like to see this at a quarter, and we've got some that I've seen at 30 and 40 cents on the dollar, believe it or not, and they're not always organic, or they're not always grazing farms either. But those are the 3 measures that I would tend to take a look at. And if I really did a detailed analysis for a banker, I'd probably look at a few of these other ones as well. But again, this rate of return on assets of 5.75% times our operating profit margin at 10.42 times the volume ATO at 55.12. So we multiply these 2 numbers together, we get that 5.75%. So again, that's the number I want to get in people's mindset. That's the equation, I think, profitability wise, we want to get in people's mindsets. And then we'll kind of look at the profitability in this farm is actually in a status of pretty good to great, I would tend to say. Profitability and cash flow are 2 different creatures that have 2 different purposes. And please don't ever use cash flow as a means to determine the profitability of a farm.
Thank you very much, Larry. Okay, I've got one question just to, I guess, get it clear in my head. When we have a small herd that doesn't have a lot of borrowed money invested, they can be profitable, but still maybe not be able to make a living on the 40 cows. Did I understand that correctly?
Yeah, so when you take a look at small herds, yes, they need to cover family living. So even though they're profitable in and as they are, and they might actually compare quite well, like on dollars return, like per cow or per labor unit per hour, things like that, but they just don't have enough cows to actually provide a family living nowadays. So, back in the day when we could have family living, I still remember when people were putting $15,000 and $20,000 in their family living in early parts of my career. And now there's a lot of families out there that think they're spending $50,000 or $60,000 a year. When you take a look at where the money goes, they might be spending $70,000 to $100,000 a year just on a family living. And so it really depends on what they need for family living. But yeah, they can still be very profitable at small herd sizes, but it might be a part-time gig.
If you could get one point that you wanted everybody to take home with them, what would that point be, Larry?
Probably that cash flow is way overused in determining the profitability decisions on a farm. And so I realize that a lot of our banking industry, they kind of need to protect themselves cash flow and equity. So that's kind of their go-to, but they're also giving a lot of advice to dairy farmers, I think trying to maybe overprotect them. But again, realizing that farms that tend to be more profitable will tend to cash flow better in the long term, but that's not necessarily in the short term. So I just basically say is that cash flow is probably being overused in our profitability decisions.
Final question. If you look at the example with the robot, that the first few years it's unlikely to cash flow, is there another capital expenditure that has that same issue? I mean, if we put in a parlor or we put in an automatic feeding system, are we looking at similar issues?
Yeah, I would tend to say that anytime you have a high cost expenditure, the difficulty of cash flowing, and again, I don't want to say that the robots don't cash flow. We've seen a lot of robots that actually cash flow quite nicely compared to what's actually happening now, especially those that are getting a lot higher milk production compared to what before. Okay, so I don't want to have that misconstrued there. But yeah, you take a look at a high cost parlor, I mean, that can definitely put a cash flow drain, especially if it doesn't increase labor efficiency. So if you're going to spend a lot of money, hopefully the money spent over time is going to come from someplace else that you have savings with labor, or things are just more efficient and things like that. So again, when you take a look at the whole concept of, as we invest in things, we just need to make sure that we're not investing just to save taxes, that we're actually investing on these farms to make them more efficient.
Thank you very much for your time and the great presentation. I think it really helped me begin to understand that cash flow and profitability difference there.
This institution is an equal opportunity provider. For the full non-discrimination statement or combination inquiries, go to www.extension.iastate.edu/diversity/ext.